All right, let's talk about Upland Software. On the surface, their latest earnings report looked absolutely fantastic, a massive beat on expectations. But then the stock, well, it dropped 10%. So what's going on here? This is the story of why the headline numbers don't always tell you the whole story. Let's get into it.
And this, right here, this is the central mystery we're unpacking. Upland came out and reported earnings per share that were a whopping 73% better than Wall Street was looking for. You'd expect a party, right? Instead, the stock got hammered, falling about 10% over the next 2 days. It's a classic case where you have to look past the shiny headline and dig into what's really driving the business.
So let's break this down. It's really a tale of two different tapes. You've got the numbers the company reported, which look great, and then you have how the market actually reacted, which didn't.
Okay, let's look at the numbers themselves. Now, I want you to focus right on that non-GAAP EPS line. Upland reported 30 cents a share. The consensus on the street, just 17 cents. That is a massive 73% beat. And it was driven by some really aggressive cost-cutting and selling off parts of the business. Even their revenue came in a little bit ahead. I mean, on paper, this is a home run.
But the market's verdict was, well, it was swift and it was brutal. As you can see from these closing prices, the stock initially popped, but then it sold off hard. It ended up with a 2-day loss of about 10%. And that tells you everything you need to know. It tells you that investors looked straight past that huge earnings beat and found something else, something they really didn't like.
So to really understand this disconnect, we have to look at management's side of the story. They're telling everyone that they are in the middle of a huge, successful transformation. And you know what? They've actually got the data points to back it up.
CEO Jack McDonald was crystal clear on the earnings call. He framed these results not as some kind of one-off fluke, but as actual proof that their big strategic plan is working. He believes the business has fundamentally improved, even if the market isn't quite giving them credit for it just yet.
And this right here, this is their playbook, broken down into 4 key pillars. Upland is intentionally getting smaller. They're selling off assets to get laser-focused. See, the goal isn't growth at all costs anymore. It's all about becoming a lean, profitable, cash-generating machine with a much safer balance sheet. And they're making real progress. They've already paid down nearly $250 million in debt.
And here's the proof in the pudding. Their adjusted EBITDA margin hit 32% this quarter. Now that's a massive jump from just 21% a year ago. This shows their intense focus on profitability is paying off in a huge way. They're literally squeezing more profit out of every single dollar of revenue that's left.
But, this might be the most important number from management's perspective, plus 3%. After years of declines, their core business, the parts they're actually keeping, is finally growing again. It's the first positive number in a long, long time, and it's a huge signal that the underlying engine might just be starting to turn over.
So, if the turnaround is working and the numbers look good, why on earth did the stock fall? Well, because the market is always looking forward. And what it saw in the guidance, despite some really exciting news about AI, was just more pain on the top line.
And here is the problem. The Q4 guidance implies revenue is going to fall a staggering 27% year over year. Now look, that's almost entirely because of the businesses they've sold, but it's still a brutal headline number. They also had to slightly trim their full-year outlook. So the market heard beat, but what it saw was another massive revenue drop is coming. And that's really the heart of it, right there. For now, investors are valuing those continued, steep revenue declines much more heavily than the impressive improvements in profitability and margins. The turnaround story's great, but the market is still completely fixated on the shrink. Now, management's counterargument to all this is that the shrinkage is masking some real momentum they have in their core AI-focused products. The CEO pointed to major new AI deals as, in his words, early green shoots that prove their strategy is creating a solid foundation for future growth. And hey, these are not small deals we're talking about. A $2 million contract with a tech giant, a $1 million deal with a global pharma company, these are huge validation points. It shows that Upland's AI tools for knowledge management are landing with major enterprise customers, especially through their deepening partnership with Amazon's AWS. So how do we square these two narratives? You've got management, who sees a successful turnaround in progress, and then you've got the market, which just sees a shrinking business. Let's try to put all this into an investment framework.
So the bull case is pretty clear, right? The profitability is real, the core business is finally growing again, those big AI deals are landing, and the balance sheet is definitely safer. But the bear case is just as simple.
Revenue is still in a free fall. The guidance points to more of the same. One good quarter doesn't make a trend, and their debt, while it's lower, is still high at 3.8 times EBITDA.
Okay, so weighing both sides of the argument, we are landing on a market perform rating for Upland Software. The turnaround story is credible, it really is, but the market skepticism is also completely justified for now.
You see, this is a classic show-me story. The market has already priced in all those margin improvements. The next big catalyst has to be growth. So until Upland can prove that these large AI wins are repeatable and can deliver several quarters of positive core growth, the stock is probably going to remain stuck. The single most important thing to watch on the next call is the momentum in that AI deal pipeline. That's the key.
This is not financial advice.